Hello and welcome to lecture 6 on forecasting. During this video I'm going to be doing a demonstration of forecasting for Gale Pacific. Here we have the Gale Pacific spreadsheet that we've used over the last few weeks, and I've started the forecasting template. Over here I've got the 2016 to 2019 data, which is brought in from our reformatted balance sheet and reformatted income statement. And then from here, column F to column J, we've got the 2020 to 2024 forecast data. The rows that are in green, these represent the 6 items that we have to forecast as part of our forecasting template. And the rows that are in orange, these represent calculations that we have to do based on the prior forecast information. This spreadsheet allows us to step through the 10-step forecasting template, and down the bottom when we're finished, we will have the calculation of comprehensive income and calculation of equity using both of the methods and make sure everything works. So here I'm just going to show you how I've done this in Excel. Step 1, I'm going to forecast my future sales. Here I have entered a sales growth rate of 1% each year. Now in this demonstration there's a big caveat. The forecast assumptions that I have put forward for Gale Pacific are not my best estimates of what's going to happen to Gale Pacific in the future. This is a demonstration of how the spreadsheet should be structured, and it is not a demonstration of the actual forecast thinking about what will happen to this business. All I've done here is enter some simple numbers to give an illustration of how to do the calculations. I haven't put in great thought into what the actual forecast situation. You'll see, just as a rule of thumb for this spreadsheet, I've been reasonably pessimistic, but I haven't even taken into account the COVID crisis in 2020 for their performance. So you'll see from the very start, my actual forecasting accuracy is going to be wrong, but this demonstration is just to help us with the spreadsheet. So starting here, in green, it means we've got a forecast number. This means we're going to make up the number, we're going to estimate it, we're going to guess. Okay, I think in 2020, Gale Pacific are going to grow their sales by 1%. Here, I've got their sales growth rate for the last few years, and I'm not just going to copy it or average it. I'm deciding 1% for this company. So then I need to do the actual calculation. I need to calculate their sales revenue. So I type equals, and I take last year's sales revenue, and I multiply it by 1 plus the percentage growth rate. Last year's sales revenue multiplied by 1 plus the sales growth rate gives me my new sales growth rate. And I'm going to drag that across so that I get my sales revenue for each year. If you look at the spreadsheet to the right here where I've got the notes, I've put all the different calculations that we need to do as well. So if you don't understand why I've got the calculation, I've also put the formula here, which is from the slides and the forecasting template. The next item I have to forecast is my asset turnover ratio. I've got my historic asset turnover ratio for the last few years, and I'm going to forecast that it decreases to 1. Now remember, each year could be different. I could say it's going to be bad this year and then start to get a little bit better next year. We can make different forecasts for each year, but just to keep things simple at the moment, I'm using the same number for each year. Once I've done my forecast in green, I can then do the calculation. I take my sales revenue and I divide through by my asset turnover ratio. And that's going to give me my net operating asset. I drag it across to make sure I get my forecast all the way out to 2024. So I've now completed my sales revenue forecasting and my net operating assets forecasting. Next, I have to forecast the profit margin for the firm, and I've used an assumption of 5% profit margin. Again, it's going to be a little bit worse than it was in the last couple of years. With this forecast of 5% profit margin, I multiply my sales. Okay, this is the amount of money I'm generating from sales. I multiply that by the profit margin, and that gives me my net operating profit after tax. If I sell $150,000 worth of goods and I earn a 5% profit margin, I'm going to be left with $7,535 in net operating profits after tax. I drag this along to get my NOPAT for each of the years. And up to this point now, I have now finished doing my operating forecasts. Remember when we did DuPont analysis, we could break down a firm's return on equity into profit margin times asset turnover ratio plus the financing effects? We've got the asset turnover and profit margin. So we're doing almost a reverse DuPont analysis here. We're taking those drivers of firms' operating performance, forecasting them in the future, and then doing the calculations on what the income statement and balance sheet are going to look like. My next step is to forecast the other comprehensive income, and I've just left it blank. If we look at Gale Pacific over the last 4 years, their average other comprehensive income is about 10. So it's almost close to zero. And I've got no reason to expect they're going to have either positive or not negative other comprehensive income in the future. So I've left that as zero. But if you know something's changed in your business and they're going to have some other comprehensive income or other income that's maybe non-recurring but's already been announced, feel free to forecast that to make sure you increase the accuracy overall of your forecast. Free cash flow gets calculated now that we've done all our operating performance. Free cash flow is equal to NOPAT minus the change in NOA. Change in NOA means I'm going to take this year's net operating assets and I'm going to minus last year's net operating assets. So we can see here the change in NOA is very close to 20,000. I take my net operating profit after tax and I minus the change in NOPAT. I get a free cash flow of minus 12,000 this year. Because my assets increased significantly by about 20,000 and my operating profit was less than 20,000, it means my free cash flow was negative. I must have gone out and financed the purchase of these operations using money other than my profit. I must have borrowed money or raised funds from my equity holders to fund this 20,000 increase in assets because it was larger than my profit. So I drag it over and we start generating positive free cash flows again. Because I had a strange asset turnover assumption here, big increase in assets. We couldn't afford to pay for those assets with our own profits. We have to either borrow money or raise capital, which is why we've got the negative free cash flow. Future years goes back to normal and we're expected to generate positive free cash flow. Next, I'm forecasting the dividend payout rate. The dividend payout rate is not truly just the dividends. It is all net payments to shareholders. So that means if the company is selling shares and receiving cash from shareholders, that would be a negative D, whereas a positive D is when the company is actually paying out cash to shareholders as a dividend. So remember, it is a net. For example, in this year, 2017, the company actually paid out more dividends than their net operating profit after tax. So it was more than 100% of their profit was paid as dividends. They had a really large decrease in their retained earnings that year. I've set our dividend payout rate as 50%. And that is 50% of my firm's NOPAT. 50% of my firm's NOPAT, I expect to be paid as dividends each year. So when I next calculate the net payments to shareholders, I say my 50% dividend payout ratio times my net operating profit after tax. I expect the company's going to earn a profit of about 7.5 million. I'm going to pay about 3.7 million to my shareholders. Next, I'm going to calculate my net payments to debt holders, which we use the notation F for. So F is our payment to debt holders and D is our payment to shareholders. So over on the side, this is the formula that a lot of people forget. F equals free cash flow minus. An easier way to think about this is free cash flow has two uses. Free cash flow can either be paid to shareholders, D, or free cash flow can be paid to debt holders, which is the F. So if free cash flow has two uses, either payments to debt holders or payments to shareholders, the formula to figure out the payments to debt holders is equal to the free cash flow minus dividends. Free cash flow minus dividends means the payments to debt holders. Free cash flow minus the dividends I've paid. Now, this means because we had negative free cash flow here, and I've got a positive payment to shareholders, I must have borrowed money. A negative payment to debt holder means that I have borrowed money this year to help pay my dividends and to help fund this increase in my net operating assets as well. So a negative number to payments to debt holders means I've borrowed money. A positive number in the following years means I'm paying back some of my debt. Forecasting the net borrowing cost comes next. So net borrowing cost, or NBC, is the interest we expect to pay on our debt. And it's the interest rate after tax. I've assumed the interest rate is going to decrease a little bit to about 3%. So this is my forecast here, this number in green. What I do with that number, I then use it to calculate how much interest I'm going to pay during the year. That is, I'm going to calculate my net financial expense after tax, NFE. To calculate how much interest I have to pay, I'm going to take my interest rate and multiply it by the amount of debt that I've got. The amount of debt I've got, I'm going to use last year's closing net financial obligations. Okay, so intuitively it makes sense. I've borrowed this amount of money and I multiply it by this interest rate to figure out how much actual interest I have to pay. So as I drag this across, blank at the moment, because what it's trying to do is it's trying to figure out my net financial obligations from this year, which is still blank. So when we fill that in, these NFEATs will also be filled in. Okay, so don't be disheartened when you do this and see that it's 0. It doesn't mean we've made a mistake. It just means we haven't got all the information to calculate that yet. So next we have to calculate the net financial obligations. To calculate the net financial obligations, we take last year's balance as a starting balance of our debt. Then we say, during the year, I've incurred this amount of interest, my net financial expense after tax. So I have to make that as a payment. So I'll plus that amount. Then during the year, any payments to debt holders. So I minus off any amount I've paid to my debt holders. In this case, I'm minusing a minus number. So it's saying that I've actually borrowed 15.9 million in this case. So my NFO, my net financial obligations this year, I started with 40,000. Then I've incurred this interest cost during the year. And my payments to debt holders was a negative, which means I have actually borrowed another 15.9 million here. So we add that up and our NFO has increased. I drag this along. Now we can see my net financial expense after tax is calculated. Okay, in here using last year's NFO and this year's interest rate. And it allows me to have my financing all forecast now. Companies normally have reasonably stable capital structures. Their debt to equity ratios normally stay pretty stable over time. It's a safe level for their level of risk within their industry and their operating model. So what we do is, because we've already got net financial obligations calculated here, and we've also got the firm's net operating assets here, we calculate their leverage as the net financial obligations over their net operating assets. And we drag that along for each of the years. This business, I forecast their leverage to stay reasonably consistent within the 30 to 40% bracket throughout their time. Okay? As I make changes to my dividend payout rate, that would lead to big changes in their leverage. We're now finished forecasting all the financing activities of the business, so we can finish off our forecast spreadsheet by calculating comprehensive income. I'm going to take my NOPAT up here and minus off my net financial expense after tax, and I get my forecast comprehensive income. I then finish off with equity, net operating assets, minus net financial obligations will give me my equity. And remember, we can calculate equity using 2 methods, so we'll do both methods. I'm going to say owner's equity is equal to last year's owner's equity plus my comprehensive income for the year minus any payments to my shareholders. These 2 methods, calculating owner's equity using 2 different methodologies, we get the same answer. And as I drag it along, we get the same answer each year for the equity. So I've now finished my forecasting template for Gale Pacific. Please remember, my forecast numbers are in green. These are the numbers that you have to make up based on your knowledge of the company, based on the historic trends, economic trends, industry analysis, strategy analysis, and prior ratio analysis. These numbers in green are the ones that you get to choose based on your best estimate of the future. The numbers in orange are all calculated based on these particular formulas that are listed next to them. Once you have these forecasts, these will be the inputs into our valuation models. We're going to value the company based on these particular numbers. We're going to use forecast comprehensive income. We're going to use forecast NOPAT, owner's equity, NOA. They're all going to be used in our valuation models. Thank you very much. I hope you found that helpful, and I'll see you guys next time.